So why do you think that this economy needs more accommodation at this moment? And why do you think it needs more than all of the other voting members on the Fed?
I think it's prudent risk management at this juncture to take account of the downside risks to the U.S. economy. Even though the economy overall is performing relatively well, we've got an ongoing trade war in a slowing global economy. We've got manufacturing down. So I think it would have been better to go a little farther at this last meeting than the majority of the committee wanted to go. But still, I would say the committee overall has made major changes during 2019. Coming into 2019, we were expected to raise rates, actually. In the January, February, March timeframe, we went to a flat path. And then in the July, August, September timeframe, we've actually lowered the rates some. So we've made a big move. I think we could do a little bit more. We've still got an inverted yield curve here. The policy rate is still above the 10-year. So I think we probably have a little bit more to go here.
The pushback I would give, President Bullard, is that we've got a good economy here as well. I mean, even housing has really started to wake up as a result of those low mortgage rates, some signs of stabilization in manufacturing, some firming in inflation. I mean, those were some of the weak spots in a market that is less than 2% from record highs. So why double down on the accommodation?
Yeah, I think some of those effects are exactly what you'd expect from the turnaround in monetary policy during 2019, housing in particular with lower mortgage rates. That's just the kind of thing that you'd expect. Monetary policy acts with long and variable lags, as Milton Friedman taught us. So I would expect the effects to show up now in the second half of 2019 and in the first half of 2020.
Does the fact that the word insurance cut has been used by you in recent speeches and by the Fed chair suggest that the data isn't that bad yet? It doesn't actually warrant a 50 basis point cut yet, but you think it's going to get worse in the short term?
Yeah, I think this is all about risk management and about the downside risks to the economy. If the economy powers through here as it did in the late 90s, then we can raise the policy rate back up. But I think the prudent thing to do right now, especially since inflation's below target, inflation expectations below target, I think the prudent thing to do is lower the policy rate now, and then if all is well next year, we can come back and go back to the previous level we were at.
I mean, you've got the flexibility, but not entirely. I mean, it's not like we're in a normal world of interest rates. What about the argument that you need to save your ammunition for when you actually might need it if we are going into a recession?
Yeah, I think the keep your powder dry argument is not as powerful as you might think. Most of the research says that what you should do is use the tools while you have them to try to manage the risks that you have. And like I say, if we play our cards right, as we did in 1998, when there was an agent currency crisis going on, we lowered the policy rate at that time. It turned out that the U.S. economy expanded right through that. Then we raised the policy rate back up. I think that was a prudent move at that time, and that's just the kind of thing we'd like to see here. Keep this expansion going, keep the labor market performing well, and keep the consumer on track.
Where do you stand, President Bullard, on the argument that trade is the biggest potential drawback to the growth outlook and interest rates aren't the most effective tool to deal with that issue?
I think trade is the biggest issue. I think the global trade war has expanded quite a bit compared to what people might have expected. I think it's going to take quite a while to get to agreements. I think the Chinese might have incentive to wait out this administration and see what happens at the election. I expect tit-for-tat types of moves, both between U.S. and China and elsewhere around the world. So that trade uncertainty is having a lot of effect inside the U.S., but is having even larger effect outside the U.S., chilling global investment. I think those CEOs that come on your show and are thinking about $1 billion investment somewhere around the world, they're thinking twice. They're being very cautious because they're not sure what the rules are going to be going forward, and they're not sure where they want to make their investments. So that's slowing the global economy. That could come back to bite the U.S. economy.
What about the U.S. consumer? How confident are you that the U.S. consumer can stay strong in the environment that you just laid out? It really has been the bright spot in this overall economy.
Yeah, I think if you just look at labor markets and consumption, you're going to come to the conclusion that this is a great economy, but that's a backward-looking way to think about things at this juncture. I think it's not surprising with unemployment near a 50-year low that you'd have great household spending. But when that breaks down, it'll probably be too late. So you don't want to wait until you see those kinds of indicators turning around. They're kind of lagging indicators. I think you want to be more forward-looking, and you want to take on board that this trade war has become more pernicious than we originally thought.
You mentioned the yield curve earlier. Does the shape of the yield curve in itself worry you? And to what extent do you think that shape is more influenced by negative yields in places like Germany and Japan than, in fact, the likelihood of recession in the United States?
I think our yields are, of course, influenced by global yields, and we have negative yields elsewhere in the G7. I think the shape of the yield curve in the U.S., though, is sending a signal that markets are less sanguine about future growth and future inflation than the Fed is. I don't see why our policy rate has to be above the general level of rates in the U.S. in this situation. If we're fighting a war against inflation, then that would be a concern. But that's not where we're at here. Inflation's actually below target by our preferred measure, and inflation expectations certainly seem well contained at this point. So I think we have room to maneuver here. I think we can take out the insurance. And like I say, if we don't need it, that's okay. We'll just take it back in 2020.
So what should the Fed do in October? Would you advocate again for a 50 basis point cut?
Wait a minute now. The committee went 25 last time. So if I was just sitting here today, I'd say another 25 basis points before the end of the year.
Right, but you wanted the 50 basis points.
Right. I'd go another 25 before the end of the year. But I would like to reserve judgment. I don't like to prejudge meetings. We'll see how the data come in. If you guys are right and I should be more optimistic, I'll certainly take that on board.
As for the dissent itself last time round, how did that go down internally? Was the chair disappointed in you?
It was a beautiful thing. No, I think we're used to arguing things out at the Open Market Committee. We have lots of different views. I think that's important. We don't want to get trapped in groupthink. You certainly had people on the other side of this argument, and they're making their case as strongly as they can. So I think that shows that there's vigorous debate going on, and I think that the committee as a whole tends to come to pretty good judgment about the path of monetary policy.
I mean, one person on the opposite side of you is Eric Rosengren of the Boston Fed, doesn't want to be cutting, and is warning actually of the costs and the risks of cutting. And in his statement, I thought one of the more powerful charts was the one where it showed that low interest rates are encouraging more leverage in underwritten, riskier debt transactions. Just this idea that the more the Fed cuts, the more it encourages risky behavior, more leverage in the system, and more potential dangerous bubbles that could end up hurting in the long term. How do you respond to that cost argument?
Yeah, I think that the Fed has better radar on these kinds of bubble issues than we would have had coming into the 2007 to 2009 crisis. We are keeping track of this. My sense is that there may be a few areas of excessive risk-taking, but nothing on the order of magnitude of what we saw in the mid-2000s, or for that matter, what we saw in the late 1990s. So right now, I don't think that that's the balance of where the balance of risks are. I think we'd be better off protecting ourselves against possibility of global slowdown feeding back into the U.S.
But do you accept those people that step back and say, if we go into a further serious loosening, easing cycle, that we're just going to delay the problems for a much bigger fallout years down the line?
Yeah, I'm not sure. One of the biggest risks we face is falling into the kind of negative interest rate trap that you see in Europe today or in Japan today. And if you get to that point, it's kind of too late. It's very difficult to maneuver at that point, as Europe is finding out. And it's not that clear how we would proceed. There are some things you can do, but it's not that clear how you would proceed. So I think the trick here is to try to use our tools while we can and stay out of that kind of situation for as long as we can.
How worrisome is this repo market stress? And should we be looking at the Federal Reserve to expand the size of its balance sheet to deal?
Yeah, we have had some volatility around the policy rate. That is something I think the New York Fed has done a good job of containing. We're going to continue that out, looks like into October here through quarter end. And so I'm pretty sure that we're in good shape for now. In medium term, I would like to see a repo facility that would complement our existing reverse repo facility. I think a repo facility would basically end any of this excess volatility in short-term funding markets. It would also meet an international standard because this is how other central banks handle this issue. I would also say about this that this is a microeconomic issue about short-term funding markets and volatility in those markets. It's not really a macroeconomic issue because in the big picture, these are too small movements to have any macro impact.
President Bullard, you just mentioned you don't want to enter the deflationary or negative rates sort of environment that some places like Japan and Germany have experienced, but you do want to cut rates. Are you saying that you would never go below zero, though, so it's just a couple of cuts, but no further?
Yeah, I think the idea of insurance is to try to mitigate the downside risks. Hopefully, those risks will dissipate in the year ahead, and then we'd be able to take the rate back up to something that was more like what some committee members think the longer-term neutral rate would be. But as far as negative rates in the U.S., I do think that there are some structural differences between the U.S. and Europe and Japan as far as how short-term funding markets work. And so I'm doubtful that it would work very well here, which is something I've said before. But I think the big picture is that you really just don't want to get into that situation where you're contemplating those kinds of policies.